Hello everyone, I'm Nova Lui, RHB Bank's Head of Investor Advisory. Welcome to our latest podcast episode where we break down key insights from recent Jackson Hole's meeting in August 2025 and discuss what potential interest rate cut could mean for your investments. In the next few minutes, we will summarize Federal Reserve Chairman Jerome Powell's key pointers on rate cuts and examine current market expectation on Fed policy. Finally, we will also take a look at historical patterns, how US equities and US Treasury has responded to past Fed cutting cycles, and highlight other factors that could influence stocks and bonds beyond just Fed move. Let's dive in. Federal Reserve Chairman Jerome Powell struck a cautiously dovish tone at Jackson Hole Symposium, opening the door to a possible interest rate cut in the coming months. While he did not explicitly promise an imminent cut, Powell noted that the Fed's policy is in restrictive territory and acknowledged that shifting economic risks might warrant an adjustment in rates, noting growing downside risks to the job market even as inflation remains a concern. At the same time, inflation is still running above Fed's 2% target. Powell stressed that upside inflation risk remains due to factors like tariff pushing up prices. In other words, the Fed must carefully weigh slowing employment against still high inflation in deciding its next move. He actually did not commit any actual rate cuts, and Powell avoided specifics on the size or number of rate cuts, focusing instead on data-dependent decisions rather than committing to a series of cuts. Based on the latest report, post-Jackson Hole's Symposium, markets are pricing in a high probability around 91% of a quarter percentage point cut at the Fed's meeting in September. This is a notable jump from about 75% odds before Powell's speech. Financial market took Powell's balanced but dovish tone as confirmation that Fed is ready to ease, bearing any upside surprises in inflation. Indeed, stocks surged, bond yield dropped immediately after the speech, signaling traders believe that a Fed policy reversal is imminent. Beyond September, markets are also pricing in another easing by year-end. According to Reuters and CME Fed Watch data, traders strongly anticipate at least one more 25 basis point rate cut in Federal Reserve December meeting, on top of the expected September cut. In another word, the consensus in market over the past week is that Fed's first cut of the year is only weeks away, and the modest easing cycle potentially totaling to a 50 basis point of interest rate cut is on the horizon. Essentially, the market is convinced that the Fed's peak rate is behind us, and that relief in borrowing costs is imminent, a sharp turnaround just a few months ago when higher for longer was the mantra. What does history tell us about rate cut and market performance? Looking back 30 years ago, the impact of Fed easing on stocks and bonds had varied depending on economic backdrop. On average, equity have performed well after Fed starts cutting rates. This makes sense because rate cut aims to stimulate growth, and if economy avoids recession, corporate earnings can improve with lower borrowing costs, lifting equities. Note that returns were even stronger when cut occurred in an expansion scenario of no recession, where probability for positive gain in equity market is 100%. For fixed income, the pattern is more straightforward. When Fed move from hiking to cutting rates, bond yield typically fall, boosting bond prices. Historically, US Treasury yield have fallen significantly in Fed easing cycle, especially since the 1980s disinflation era. This means bonds tend to rally when Fed eases, delivering capital gains in addition to interest income. Summing up the lessons, if Fed manages a soft landing where rate cut in a non-recessionary environment, a rate cut cycle can be a sweet spot where both stocks and bonds generate positive return. Stocks rising on better growth prospect and bond rallying on lower yield. But if cuts are happening in the midst of a hard landing, bond will likely outperform, benefiting from a flight to quality and Fed support, while stocks struggle until the economy shows signs of recovery. Investors should therefore calibrate expectations. A Fed rate cut is not a magic bullet for equity in every scenario, but it has always almost been a tailwind for bond prices. While Fed policy is crucial, investors should not fixate solely on the interest rate. Other forces can heavily influence equity and fixed income market in the coming months. One major factor is the broader economic outlook and corporate earnings. Another factor is valuation and competition from bond. We have enjoyed a long period where interest rates were near zero and stocks were the only game in town. Now with short-term treasury yield around 4 to 5%, fixed income presents a viable alternative. If the Fed only rate cuts gradually, yields could remain relatively high. Higher bond yield can draw some money away from equities, especially if stock valuations are rich. To wrap up, the Jackson Hole meeting has given investors a lot to chew on. Jerome Powell's balanced message, acknowledging rising risks, also guarding against inflation, suggests Fed is prepared to cut rate, albeit carefully. Markets are certainly excited by the prospect of easier monetary policy, already pricing in a September cut. But as we discussed, it's wise to temper expectation of any aggressive rate cut this year. The Fed may move more gradual, especially if inflation proves sticky or growth doesn't deteriorate fast. We learned that historically, Fed rate cut has often boosted both stocks and bonds, though the magnitude really depends on whether we are heading into a recession or not. For retail investor, what does this all mean? If you are invested in equity, keep an eye on the Fed, but also on earning and economic data. Keep your global portfolio diversified into equity, income strategy, and Asian equities. While in fixed income, today higher yield means bond finally offers solid income. And if Fed to cut interest rate, you could see price gain. It will be a good time to review your investment portfolio. Ensure that you have a diversified across asset classes and geographical exposure. The rate cut narrative is important, but it's just one piece of the puzzle. Thank you for tuning into this episode. I hope our deep dive has given you a clearer picture of the rate cut prospect and their investment implication. Be sure to refer to our Q3 fund discoveries to get some ideas on how this fund can fit into your investment portfolio. As always, we will keep monitoring this development for you. If you have any question, please engage your RHB Bank's relationship manager. Until then, this is Noah Loy from RHB Bank Investor Advisory, signing off and happy investing. Stay informed and take care.